really soon, but maybe by next week you'll be another. What's that? Your fourth kid?
Yeah, that'd be number 4.
Is that it? Or are you still going to do like 10 more?
For me, the more the merrier. So we'll see. Just might have to get a bigger house.
Yeah. Well, if you need a loan, you know where to come for that.
I do.
All right. So today's actual thing was buyer beware. It was kind of a play on the fact that what you've been hearing and you brought to my attention is a lot of people, buyers, have been saying, I'm going to wait. I'm hearing that I should wait. I'm going to wait until the market drops. I'm going to wait till all this. So is that what you're hearing?
Yeah, there's been a handful of people that have said, you know what, I'd really love to own a home, but I feel like the market's going to collapse, and so I'm going to buy when it's low. And I'm hearing it so often that I thought it was something that we should talk about, because you turned me on to Keeping Current Matters, and so they had an article on there that I thought was really good that I wanted to discuss, and it was the 5 main causes of an industry crash. So I'll list them off real quick, and then if we can go through each one
let's do them real slow. And the industry we're talking about is the real estate industry, but this could be 5 causes for any industry. But what we're looking at is how it affects the real estate industry, of what it could happen. So what's your first one?
Yeah. So item number 1 is item or service becomes obsolete. Now, luckily,
that's not happening.
Yeah, luckily in the real estate industry, people are not going to stop needing homes. So we know we don't have to worry about that one. Item number 2 is demand for item or service drops dramatically. Now the demand, once again, everyone needs someplace to live. I guess it depends on whether or not we're talking about renting versus owning, right? So I know we're obviously, talking to the folks that are renting right now saying, hey, it's still a good time to buy. Item number 3 is demand for item or service was artificially generated.
And so that would be 2002 to 2006, when we talked about that before, where they thought all the people were coming of age to buy homes, average age 31. We had all these loan programs that artificially inflated the need for these homes. You watch the movie The Big Short. There's a stripper in there who owns 3 houses, going to buy her 4th house because she doesn't have to qualify. She's just able, as long as she has some money to put down. And some of those programs were 100%. So that's what they're talking about. That's not happening right now. So 1 and 3 definitely aren't happening. We're not artificially inflating it right now. They're right. This is demand artificially inflated, right?
Yeah, correct. Yes. Demand for item was artificially generated.
Right. So the only caveat to that is the exodus out of the Bay Area into, other areas for a while there, caused a lot of demand in the, like, say, Tuolumne County, the other areas. But there is still a lot of people looking for homes in all those areas. So I don't know if that, so anyway, next, I'm sorry.
Yeah, no, you're fine. So next one is supply of item or service increases dramatically. That obviously is not a problem that we have, because unless they can start building millions of homes, we're not going to have a sudden increase that's going to collapse the market.
What is the current, what do we have, 0.8 of a month in inventory right now?
Yeah, it fluctuates in between 0.8 to 1.1 months of inventory, but still way below what a standard market is.
Right. And so what I think they're talking about is we would go from where we are now to the complete opposite side of the scale, where it would be no longer, so we're in a seller's market, right? 6 months inventory is a balanced market. Correct. And then on the other side of that, then it becomes a buyer's market, where buyers can just write their terms on whatever they want. It would have to go that side in order for what that whole demand would happen. And I don't see that happening. But
yeah, and so I wasn't in the sales side during the last downturn in the market, but what other agents have told me, they had anywhere from 12 to 16 months of inventory. So if that gives people kind of something to base their judgment off of, if this is still a healthy market, 12 to 16 months during a downturn versus 0.8 to 1.1 months.
Yeah, and a lot of people ask me, when is a good time to buy? My answer is always when you're able to buy.
Yeah. And so for those folks, I had friends back in 05, 06 that bought houses, and they bought them because they said, well, I can afford the interest payments, and then before the balloon payment comes, I will have made $200,000 and I'll sell my house. And we all know how that worked out. I only had one person I know that honored the loan that they signed and waited until the market recovered and sold. So
everybody else got rid of them and bought another one.
Yeah. So it doesn't matter what market it is. I always tell buyers, if you're thinking you're going to buy something and turn a profit in a year or two from now, and we don't know if the market's going to be there, but if you're looking 10 to 15 years out, there's always going to be appreciation.
Right. And what we're looking at also is speculative or speculating market. And when you buy something because it's going to go up in value and that's your whole plan, most people are buying a house to live in. And the
Yeah.
way it's looking now, it's no longer is it 7 years, it's not 10 years. Most of the people are buying now because the rates are so, have been so low over the past year and a half. They're going to be there for 15, 20 years. They're not moving. So the stability of the market is going to be there because there aren't people going to just sell it. I'm going to sell it right now and get out of it. That's not going to happen. People are going to stay in their home and pay and probably pay them off, which is unheard of for us. And it's been that, for a long time.
Yeah.
Because they'll actually, what people will do is instead of buying that bigger house, like you said, if you haven't had a child or more children, they'll work on remodeling that house or whatever they need to do for a short period of time. So I don't think we're going to see the people who buy that first home sell it to buy the move up home and then sell it to buy that house they're going to go back to when they got rid of all their kids. I see people are going to get into the first home and it's going to be big enough and they're going to squeeze enough people into it to stay there till that's their last home. That's what I see.
And it is kind of nice seeing that paradigm shift where people are thinking about staying in their homes long term and selling it and paying it off. Because like our grandparents' generation, I guess it'd be my grandparents' generation.
My parents' what are you trying to say? I'm old.
Yeah. That was the thing, right? They would pay off their house and they lived in it till the day they died, and then the kids inherited it, and it was normally sold off, and everyone took their share of it. But that was the idea. Like once you bought a home, that's where you were going to live, unless you had a job transfer or something. Nowadays, 5 to 7 years is the average span that someone stays in a house, which is nice for the real estate market because then you have something to sell again. But then that takes us to item number 5, which is demand or item for service impacted by outside market dynamic. And so that's kind of like an open-ended.
Well, that's right now, that's our government. I'm not trying to get political here because that's my other show. But basically what we're looking at right now is the fact that with inflation and certain things happening, rates are going to go up. It's not, are they? No, it is. It's just a matter of when are they going to go up. But the only other side of that is they're going to do anything and everything in their power to keep these rates artificially lower than they should be because of the debt burden that's going to affect their debt burden that the government has been creating. So we're going to see rates, but I don't think we're going to see 6%. We're probably going to see high 3s, maybe low 4s, which sounds, oh my goodness, coming to an end there.
No, that's pretty good. I mean, my rate is 4%, and I bought back in this house back in 2011. So
yeah. Right. And it sounds really high to what we were used to, but what I'm hearing is we're going to hit a recession. We're going to see rates go down, in end of 22 into 23 and beginning of 23. We're going to start seeing that recession happen. It's going to happen somewhere in there because the stimulus programs are going to be gone. And then we're going to see these interest rates rise over the next, year, which they're kind of doing now. They're moving up a little bit. They're not moving up fast right now, but when rates really move, they move fast. I mean, they'll move a half a point or a point within a short period of time. So you have to be really careful. So if you're thinking, I'm just going to throw this out. If you're thinking about buying, look at the numbers now because house prices are still reasonably priced, right? Yes, they're going up ridiculously. But if you look at the affordability, we're still the most affordable we've been since the Great Recession.
And, with my background in rental properties, I always tell folks, like, once you have your mortgage, it may change by, $50. If they don't
Hold on. That's not your mortgage payment changing. That is your insurance or that's your impound account. Yeah. Because I had a question on one of those things I'm doing on TikTok was, can your mortgage payment change? Your mortgage principal and interest payment won't change, but if you impound it where your taxes and insurance in there, yes, it could change because your insurance will go up, your taxes will go up over time, 3% of whatever they go up, you will adjust. And yes, that payment can change. I'll let you get back to your point. Sorry.
Yeah, well, for the average person, until they knew like what you just told them, they would just say, "Hey, my payment has gone up," right?
Right.
And that's obviously because they're estimating what your taxes are going to be. So, but you're talking about a very small percentage of an increase, right? Where in the rental industry,
Yeah.
there's
$50.
there's a rent cap right now, and that's $50 every lease renewal.
Right.
That's every year. They can only do it annually. 5% if they're in the safe zone, 7% if they really want to push it. But so getting back to that list, is it a good time to buy? I think it's always a great time to buy. There's always somebody buying and selling a home, whether the market is, crazy high, whether or not there were, like during the recession. I know plenty of people that bought homes. They bought them for a little bit less, but they're still buying and selling houses.
Right. And I mean, during that, again, goes back to when is a good time to buy? When you can afford it. That's the best time to buy.
Yeah.
Don't listen to people saying, "Oh, I'm going to wait till it crashes," because we don't know if that's going to happen. The things I look at and the things I've read, I don't, we have to have some major thing happen where, and I tell someone, one of the things was, when's the market going to crash? Well, where the demand outweighs the supply, right? When we have more supply than demand, that's when we might start seeing a crash. I don't see that happening. I still think there's people who are trying to buy. People aren't trying to buy a ton of additional houses. There might be a few people buying a second home here and there, but not many people. We're still having those people who can't find a house to get into. They keep getting bid out. I mean, I'm trying to help some people in Southern California, and you're thinking, oh, it's easy to buy $1 million homes down there. Oh my goodness, they're getting bid out left and right in Oceanside and San Diego. It's ridiculous. And it's not REITs that are buying these houses. These are individuals buying the houses. So,
well, and if you're looking for a rental home, that market is, just as tight as the sales market. I mean, you might have as many as, 8 to 10 applications for the same home. And then they pick from the most qualified people who's going to get that house. So folks that are already in the rental market see that there's a challenge there. And if they're qualified, they might as well be trying to buy, because you're going to be at the mercy of a landlord indefinitely until you own that home.
Right. And you have to also remember that it's harder to rent than it is to buy, right? I mean, we have a minimum FICO score. I mean, you can go lower, but I don't recommend it, of 620. How many people do you rent to at 620?
No, minimum was always like 650.
Yeah. So, I mean, so it's still not that I want that buyer to, be in that situation, but if you are, you can still buy. Where renting, they're going to say, no, we're going to go with all these other people. Where for me, I always wanted that person, because that way I knew they weren't going to move.
Yeah.
Right. The higher the FICO score is, means that person is going to start thinking down the road, I need to buy, because most people still think 20% down is what I need. You don't. You need VA, USDA, no money down. You can do 3% conventional first time home buyer. You can do 3.5% FHA. Those are the minimum. And we didn't get into the V. Did I say VA? I know I can't remember.
Yeah, briefly mentioned it. Yeah, with USDA. Yeah.
Okay. So, I mean, there's so many programs to get in. A lot of people want to use down payment assistance programs. The problem with this market is, until we skew more towards a balanced market, it's really hard to do down payment assistance programs, because they don't need to wait for you to go through that process. So.
Yeah, exactly. Yeah. I mean, people are jumping on the most qualified buyer first, obviously.
Yeah. Well, they look at the contracts, right? You guys all have a system. All right. Let's put all these 10 or 6. Let's just say you only have 6. They're going to go, okay, who has the most money down? And then the next, all the way down. You're going to go for the person putting the most money down, just in case that value doesn't come in. Right.
Yeah, absolutely.
And they have more room to work. Where we talked about this on one of our shows, that basically, if you are looking at a veteran and you have $20,000 in the bank, you can always say, I'm doing it 100% financing, but I will pay up to $10,000 over the appraised value, or whatever that number is, in case it doesn't come in. They just need to know you have that money. They don't even think veterans have that money to do that. And you need to make sure you state that as the buyer's agent to the other side, saying, okay, I know you've seen his only has 100% financing. That's only because he doesn't have to, or she doesn't have to, or they don't have to, if you want to do pronouns. So this is the issue, is that they have the money, they just don't want to put it into the down. They want to keep it to do things to the house, so they have that money if they need it. So there's a lot of stuff you can do. So, but that's both sides.
Yeah. Well, and if that's really the hinge pin, you can always have like a proof of funds, and you can show them that they're, the lender that they went through obviously did a good job pre-qualifying them. Interesting.
Pre-approving.
Or yeah, pre-approving. Sorry.
We don't want to pre-qual ever.
Well, so I was just going to the RPA
explain
training.
that.
Well, that's what I'll touch on it since we just went through it today. So on the training for the new purchase agreement, they could not find a consensus on the difference in between pre-qual and pre-approval, or a fully underwritten pre-approval. This is based in California, like the people that are contributing to the new RPA.
Right, explaining it to you guys.
The residential purchase agreement. Yeah, so it depended on where in California you were, if pre-approval versus pre-qualified meant the same thing. So anyway, yes, here we want a pre-approval.
Right. So for us, a pre-qual is basically you call us up, we're talking to you, you tell us how much you make, you tell us how much. I'm sorry, the elevator next to me. You tell us how much money you have for down. We run and here's the difference. Some companies don't even run their credit. We run the credit to see what that numbers are and what they can qualify for. And you run it that way. That's a pre-qual. That doesn't mean anything, right? Most people have no idea how much money they really make. They don't know how much they have. They just, I think I make $19 an hour when sometimes they're making 25. They have no idea what they're making. Mm-hmm. So we always do pre-approval, which means we run their credit. We get that information from them, but they back it up with their documents. They send in 30 days of pay stubs. They send in the bank. Sorry about that noise. I'm getting somebody coming through. So they look at all these different things. So what I say, bank statements for their down, pay stubs for how much they make, W-2s for the last 2 years, and verify. And then of course, driver's license to make sure it's who we're talking to. And we run the credit. We run all those things together. Then so that's a pre-approval. Then we take it one more step further, and a lot of people do, is then you go through the underwriting engines through Fannie and Freddie to see if they qualify through that and what comes back, if things they need to do. And on that underwriting stuff, it tells us easily, if you send in these things, your client will be approved. The next step is actually to send that into an actual underwriter, and that's a TBD. And a lot of people, during the last year, a lot of people weren't doing TBDs because we had so much volume, we just couldn't do it. But if you do through at least the DU or LP, that's the Fannie and Freddie underwriting engines, we know. And you can ask that loan officer, hey, did you do this? Yes. Can you send it to me? And then, if they send it to you, they have to get the client's approval. They'll tell you if it's been done or not. You only need a first sheet to see if it's been done, if they have if it's eligible or ineligible. So
now, how quickly does the underwriting come back when you do it through the automated system?
Seconds.
Yeah.
Yeah. I mean, all this, we're talking 10 minutes. So if someone's taking longer than 10 minutes to approve you, go to somebody else.
Yeah. Go to Ed Parcaut.
Yeah, that works too. And you can find me everywhere at Ed Parcaut. That's everywhere. That's how I am. Except on Facebook. I think my original one was Edward Parcaut, so we never changed it. And that way, if people call me and want to talk to Edward, I know I don't know them.
Yeah. Well, I was looking over this list, and I think you pretty much answered any questions that I might not have answered. Is there anything else you could think of?
No, I just want to tell people, don't listen to the news out there. Do what's best for you. Don't listen to other people who talk at parties about how they did this or what their rate is or how they did this is usually wrong. They're not telling the truth. Because I know a lot of people want, when they call me, no one ever calls me and say, I want the highest interest rates and the most cost. They always say, I want the lowest interest rates and the minimal cost, which is standard. I mean, nobody wants to pay more than they have to. Yeah. But you have to remember, if someone quotes it themselves, hey, I got this rate. You don't know how much they paid for that rate to get that rate. Because that's another thing that we can have on where I don't agree in buying the rate down. You look at what par rates are. Par rates means that if the rate is at example 3% and there's no cost, that's par. And I'm talking just the rate. I'm not talking underwriting fees, processing fees, all those other garbage fees. I'm not talking about those things. I'm talking about just the discount points for the rate. That's discount points are what you're buying the rate down. Excuse me. that's important to know, that you shouldn't pay for discount points until you look at what the difference in between par is and how much that costs for the going down lower. Okay. Because sometimes it's only a difference of $10, but it's going to cost you $3,000. It's not worth it. Right. Because it'll take you 300 months to pay yourself back. You don't even know if you're going to be in that house 300 months later. That's almost 30 years. Right. So you have to have somebody like me that goes through and runs the numbers and say, okay, if you do this, this is what it's going to save you. This will save the interest over the life of the loan. This is why it makes sense. This is why it doesn't make sense. If you make an extra 12th of a payment monthly, it's going to take your loan down to 22 years or 21 years. You run the numbers, tell them, and there's so many different things. So you just want to make sure you're working with somebody you trust and that you get referred, and you want somebody local so that you know where to go if there's an issue.
Absolutely. Absolutely. Yes. Learned my lesson the hard way on that when I had a buyer come to me with a out-of-state brokerage. So yes, please go local.
All right. I'm good. You good? Did we answer everything?
No, right. I think so. I think we're good for today.
And then we decided we're going to do these more often. I hope everybody's okay with that. To do more often, like maybe Monday, Wednesdays, and Fridays, to get some more accurate information out there. You still up for that till the baby comes?
Yeah, absolutely.
All right.
Maybe I'll bring him in with me. We can answer questions together.
Yeah, we'll be sleeping at that time. In the beginning, they always sleep, and then later they don't. All right. Well, Robert, thanks for being here today, and we'll set something up for Wednesday.
Okay. Thanks so much, Ed.
All right. Have a good day.
You too.
All right.
Bye.